Are you tired of living paycheck to paycheck and want to build a secure financial future? If so, then you won't want to miss what's coming up. By the end of this video, you'll have a comprehensive understanding of how dividend investing can help you achieve financial freedom. So sit back, relax, and stay tuned until the end to unlock the secret to financial stability and independence. Dividend investing is a popular investment strategy that is focused on building wealth through stocks that pay dividends. The main objective of dividend investing is to generate a reliable and steady stream of income while also taking advantage of potential stock price appreciation. This type of investing is especially appealing to investors who are looking to achieve long-term financial goals, such as building wealth or securing their financial future. What are dividends and why are they important? Dividends are payments made by companies to their shareholders, usually in the form of cash or additional shares of stock. They are a way for companies to share their profits with investors and to reward long-term shareholders for their loyalty. Dividends are important for several reasons. Firstly, they provide investors with a steady stream of income that can help to reduce financial stress and provide a cushion against market volatility. Secondly, dividends can be a sign of a company's financial stability and profitability, as they are only paid if the company is making money. Thirdly, dividends can serve as a means of reinvesting in the company and building wealth over the long term. In addition to their financial benefits, dividends can also be a useful tool for diversifying a portfolio and reducing risk. By investing in dividend-paying stocks, investors can balance out their portfolio and minimize their exposure to market swings. How to choose dividend stocks? Understanding dividend yield. The first step in choosing the right dividend stocks is understanding the concept of dividend yield. Dividend yield is the amount of annual dividend income you receive divided by the current stock price. This metric is expressed as a percentage and is a crucial factor to consider when evaluating a stock for investment. A higher yield generally means a higher income, but it is important to also look at the overall financial health of the company and its ability to continue paying dividends in the future. Evaluating a company's dividend growth history. When choosing dividend stocks, it's crucial to assess the company's ability to maintain and grow its dividend payments over time. One way to do this is by looking at the company's dividend growth history. For example, let's consider two well-known blue-chip companies, Johnson & Johnson, J&J, and Coca-Cola, KO. Johnson & Johnson has been paying dividends for over 130 years and has a strong history of consistent and growing dividend payments. In fact, J&J has increased its dividend for 57 consecutive years, making it a dividend aristocrat. This demonstrates J&J's commitment to its shareholders and its ability to generate consistent earnings and cash flows. Similarly, Coca-Cola has been paying dividends for over 120 years and has also shown a strong track record of growing its dividend payments. In the last decade, KO's dividend has grown at an average annual rate of around 5%, which is a good sign of a healthy and sustainable dividend. Considerations for debt, earnings, and free cash flow. When evaluating a company's potential for dividend growth, it's crucial to consider its financial health. This includes evaluating the company's debt, earnings, and free cash flow. Debt. High debt levels can put pressure on a company's finances and limit its ability to pay dividends. It's important to look at the company's debt-to-equity ratio and compare it to other companies in the same industry. If the debt-to-equity ratio is high, this indicates that the company has a significant amount of debt relative to its equity and may not have enough financial flexibility to pay dividends. Earnings. The company's earnings are an important factor in determining its ability to pay dividends. Companies with consistent and growing earnings have a better chance of paying and increasing their dividends in the future. You can look at the company's earnings per share, EPS, and revenue to determine its earnings trend. Free cash flow. Free cash flow is the cash a company generates after accounting for capital expenditures. This is important because it indicates the amount of cash available for the company to pay dividends, invest in growth initiatives, and pay down debt. Companies with high free cash flow are more likely to be able to pay and increase their dividends in the future. For example, Johnson & Johnson, J&J, has a debt-to-equity ratio of 0.48, which is lower than the industry average. It also has consistently growing earnings and has increased its dividend for 57 consecutive years. Coca-Cola, KO, also has a manageable debt-to-equity ratio of 0.5, a strong earnings trend, and has increased its dividend for 64 consecutive years. These factors make J&J and KO strong candidates for dividend investing. Selecting stocks with sustainable dividends. When choosing dividend stocks, it's essential to look for companies that have a track record of paying out sustainable dividends. To assess sustainability, investors may consider factors such as the company's payout ratio, which measures the amount of earnings being paid out as dividends, and its dividend coverage ratio, which measures the ability of the company to continue paying dividends based on its earnings. For example, pharmaceutical giant Pfizer, PFE, has a low payout ratio and a strong dividend coverage ratio, making its dividends highly sustainable. Similarly, utility company Dominion Energy, D, has a history of paying sustainable dividends with a low payout ratio and strong dividend coverage. These are just a few examples of stocks with sustainable dividends that investors may consider when building a dividend portfolio. Building a diversified portfolio. Diversification is one of the most important principles of investing. By spreading your investments across different asset classes and types of securities, you can reduce the risk of losing money in case one investment performs poorly. Diversification helps to reduce the overall volatility of your portfolio and increase the chances of earning consistent returns over the long term. To ensure that your portfolio is well diversified, there are several strategies that you can consider. One of the most popular strategies is investing in different types of securities, such as stocks, bonds, and other investments. This can help to minimize risk and maximize returns, as each type of security may react differently to market conditions. One way to diversify your dividend portfolio is by investing in blue-chip stocks, which are well-established companies with a solid track record of steady growth and high dividends. Examples of blue-chip stocks include Johnson & Johnson, J&J, and Coca-Cola, KO. Another strategy is to invest in dividend aristocrats, which are companies that have increased their dividends for 25 consecutive years or more. These companies are known for their steady and consistent dividend growth, making them a popular choice for dividend investors. Real estate investment trusts, REITs, are another option to consider, as they can provide a steady stream of income and diversification benefits. REITs invest in real estate and provide investors with the opportunity to invest in a variety of properties, such as office buildings, shopping centers, and apartments. In addition to stocks, high-yield bond funds can be a good option to consider. These funds invest in bonds that pay higher yields than traditional bonds, making them an attractive choice for income-seeking investors. Another way to diversify your portfolio is to invest in both domestic and international stocks. By investing in companies from different countries and regions, you can spread your risk and reduce the impact of any single market's performance on your overall portfolio. Balancing risk and reward. It is crucial to understand that risk and reward are inherently linked in investing. Higher risk investments have the potential for higher returns, while lower risk investments tend to have lower returns. Investors must determine their comfort level with risk and adjust their investments accordingly. To achieve a balance between risk and reward, it is important to properly allocate assets in a portfolio. This means considering the allocation of assets among different investment classes, such as stocks, bonds, and real estate, to ensure that the portfolio is diversified and the risks are spread out. Balancing risk and reward in a dividend portfolio requires careful consideration and planning. One strategy is to allocate assets based on the investor's risk tolerance and financial goals. For example, a conservative investor might choose to invest more heavily in high-quality bonds and blue-chip stocks, while a more aggressive investor might focus on dividend growth stocks with higher yields. Another strategy is to implement an asset allocation strategy, such as a balanced or target date portfolio, which automatically adjusts the mix of assets as the investor gets closer to their retirement age. Additionally, regularly reviewing and rebalancing the portfolio can help maintain the desired risk and reward balance over time. It is important to seek professional advice from a financial advisor when deciding on a risk management strategy for a dividend portfolio. Maximizing your dividend income. Reinvesting dividends is a smart strategy for long-term growth. When you reinvest your dividends, you are using the money you earn from your investments to purchase more shares. Over time, this can result in significant growth and compound returns. There are many strategies for maximizing your dividend income, including investing in high-yield dividend stocks, investing in dividend growth stocks, and investing in dividend exchange-traded funds, ETFs. Additionally, it is important to consider the timing of your investments, as well as the overall health and stability of the companies you are investing in. To get the most out of your dividend investments, it is important to regularly monitor and adjust your portfolio. This includes reviewing your portfolio's performance, adjusting your investment strategy as needed, and considering new investment opportunities that align with your financial goals. By staying informed and making changes as needed, you can ensure that your portfolio is working optimally to help you reach your financial goals. Common pitfalls to avoid. Investing in dividend stocks can be a lucrative way to grow your wealth over the long term, but it's important to avoid common mistakes such as not doing enough research on the companies you invest in, not diversifying your portfolio, or not considering a company's financial health. Dividend investing requires due diligence, and by avoiding common mistakes, you can help minimize your risk and maximize your returns. Market downturns are an inevitable part of investing, and it's important to have a strategy in place to protect your portfolio from losses during these periods. A popular strategy is to invest in low-cost index funds or exchange-traded funds, ETFs, that track a broad market index, or to use stop-loss orders to limit your potential losses. Additionally, by investing in a mix of asset classes and diversifying your portfolio, you can help reduce your exposure to market risk. There are several key considerations to keep in mind when investing in dividend stocks to avoid costly mistakes. This includes staying patient and not making impulsive decisions based on short-term market conditions, not chasing high yields, and avoiding dividend stocks that have recently cut their dividends. By keeping these key considerations in mind, you can help ensure that your dividend investing strategy is successful in the long term.